Good morning to our folks here on the East Coast, and really early morning for our friends on Central Mountain Pacific Time. Thank you for tuning in. Today's topic is client-centric estate planning with private financing. So we have been obsessed with replenishing our pipeline, coming off of a big paid for month of April in the insurance business, whereby anything that was opened or in discussion as of January, February, March was rushed to closure in April due to an ongoing pandemic, uncertainty, agents being at home and extremely active in their pending case pipeline, and clients just with a high demand for closure. What we've seen post-April, that this lower sense of urgency and case sizes have gotten smaller because the meetings with tax advisors, wealth advisors, legal advisors just aren't taking place. So the purpose of today's webinar is to showcase an idea on how to complete estate planning in the world of COVID without having to be exposed to medical examiners, tax attorneys, estate planning attorneys, wealth advisors, insurance advisors. So this is a tried and true strategy that is extremely timely and we think can generate pretty significant sales for you. So when you look at today's estate plan, it's no longer head over to the tax attorney's office and you set up an ILIT and marital AB trust, you buy a second to die policy to pay any death taxes, and then kind of game over. But today is very different, and the focus is no longer on the beneficiary, the focus is on the client. So the definition of client-centric, when we call it the client-centric estate plan, the definition of client-centric is a specific approach to doing business that focuses on the consumer, on the client, on the consumer. What can this plan do for me? So keeping the beneficiaries in mind or the family in mind, we also need to showcase what the planning can do for the customer. And this is not a political presentation, but I think, to say the least, we're living in a world of uncertainty. Social issues, political issues, financial issues are being tossed around like political footballs. We have an election coming up in November, and for the time being, the tax gorilla left the room. But that tax gorilla, and we've seen warning signs, right? This $3.5 trillion stimulus just took us over the $25 trillion mark in national debt. And this is the highest ratio of national debt to GDP that we've seen since World War II. We actually surpassed World War II levels. And shortly after World War II, the income tax rates were like 80%. So, the tax gorilla may have temporarily left the room, but he vowed to be back bigger and stronger. So, what we saw in terms of estate planning was that clients were on the sidelines until 2025 when the law reverts back to 2017 levels. And currently we see a $22 million exemption. So a lot of customers think, well, I'm not worth $22 million. I don't need to do any estate plan. But that reverts back to approximately $6.5 million in 2026, which now brings a whole different demographic into the realm of estate planning. Currently, the Democrats are leading the polls. Joe Biden is making a strong push to challenge the incumbent Donald Trump, and the Democrats will almost certainly have never supported federal estate tax repeal or the $22 million exemption. So you can almost certainly, we know what the law is, and the law is set to sunset back to the $6 million number in 2026. But the question is, if the Dems get in the office, will they make that change prior to 2026, and what will that level be? So the new estate planning COVID 2019 or COVID-19. Income planning. Make sure I don't run out of money. Make sure I can maintain my lifestyle. Give me safety. Give me security. That's been number one. 2 is asset protection. I've accumulated a bunch of assets. Under no circumstance do I want my future ex-son-in-law to inherit my life's work. I don't need any exposure to creditors. Make sure those assets are protected. 3 is chronic illness. We've seen a huge concern in nursing homes, and forward thinking, right? Clients are looking to do whatever they can to stay independent, stay in their homes, and have adequate care. And then lastly, we're looking to fund death taxes, right? Any transfer taxes, leave a legacy. As long as I can meet the demand of my income goals, chronic illness, then in anything in excess, we're going to use to create a legacy. Chronic illness is big, particularly in this nursing home crisis that we're currently facing. And there's 157 million people who suffer from chronic illnesses. These people, you just can't see their disabilities because 96% of them are invisible, right? Chronic illness is not just for the wheelchair bound or walker bound or in nursing homes. You'll see that there's actually some very early diagnosis of these chronic illness, like MS is an example. Early diagnosis, 30s, age 40s. Parkinson's is typically midlife, 50s and 60s. There are 9 million cancer survivors. Many of them have after effects from treatment. COPD, when you think of COPD, you think of the 82-year-old, 50-year smoker on an oxygen tank. But the reality is the most common diagnosis is females in their 40s with some type of bronchial or asthmatic or emphysema type chronic illness. So this is a big item today that we can actually solve by repurposing assets from the balance sheet to products that we sell outside of the taxable estate, all while keeping in mind income and chronic illness goals. As far as the permanent, quote unquote, permanent federal state tax, well, that exemption was never permanent in the first place, right? This is a moving target. So why not set up the estate for success while maintaining flexibility, liquidity, and control? And we kind of shake this thing out and see how it lands. So there are a lot of advisors that are pushing clients to take action before the sunset of 22 million down to 6. I would suggest that maybe you don't have to do that. You could take a wait and see approach, which we're going to do here. If your intention is, I'm going to give this away and I'm never looking back, and that's what I want to do, then by all means do it. Make the gift, complete the gift. But the strategy I'm about to share with you now gives you a lot of flexibility in that. Later on, if you want to complete the gift, you can. If you don't want to complete the gift, you don't have to. But you are creating significant wealth outside of the estate. So we know we live in a world of uncertainty. There's likely more uncertainty to come in 2020. So why not dive into a case study that shows optimal flexibility? So here's Lisa C. She's a 51-year-old female in great health. She's divorced. She has 2 unmarried children, 2 annual exclusions. So I have $30,000 to work with by way of gift. She's liquid. She's very concerned with bond yields that, historically over the last 5 years earning 1.8%. So her rates of return aren't very good. She's concerned about income. She's concerned about volatile stock markets. So right now she's highly liquid, and she doesn't quite know where to park her money. She's a 1%er. She likes the tax favorite attributes of cash value life insurance. We showed her a high blended whole life. You can also look at IUL, VUL, whatever your risk tolerance or flavor is of preference. Loves the tax diversification of cash value life insurance and the potential tax-free income later on. Wants to gift, thinks it's a smart idea to gift, but worried that it's just doesn't want to make a forever gift. Worried she may run out of money later in life, and that's her number one concern. So although it's smart, although she's kind of under the gun to make a move before the tax law sunsets, she wants a program that kind of gives her some flexibility, that if she wants to unwind it, she can. If the tax laws work in her favor, she can get her asset back. If they don't work in her favor, she can complete the gift. So, we're thinking about a private loan or private financing, however you want to call it, private split dollar. Keep the life insurance death benefit outside the taxable estate. And a big concern is, I don't want to be a burden to my kids if I become chronically ill. She has 2 boys, didn't feel like it was fair for them to take on the burden of caring for her in the event she couldn't complete 2 of 6 activities of daily living. So let's dive in. So in this strategy, Lisa C is making a loan to her family trust. It's a very simple loan transaction. Just like if you were to make a loan to me, we would bookkeep it. We would draw up a promissory note. Could literally go online, download a promissory note document, sample document in seconds, and we need to account for loan interest per the IRS. And right now, the really attractive piece of this, and I'm about a day behind because June numbers came out at 1.01, but the deal between Lisa and her trust in this loan is at a long-term rate of 1.15%. So $1 million gets lent to the family trust at 1.15%. Now, a loan is not a gift. It's very different. Loans can be paid back. Loans can be foreclosed on. Loans are not a completed gift. So the ongoing gift commitment is 1.15% of $1 million. And I can cover that obligation using one annual exclusion, which is pretty amazing. We put together a nice little one pager. It's 22 columns. It's virtually impossible for you to read in this on this screen. So what I'll do is I'll break it out into quadrants, but you'll see how the presentation flows. So the private loan looks like this, right? The family loan is made to the trust at 1.15% upon Lisa's death. The estate gets repaid that same $1 million, and along the way we need to either pay back to Lisa $11,500, which is the loan interest. It's just very simply column 8 times column 9. Either pay her back the $11,500 or just impute it as a gift using her annual exclusion. Once the trust takes receipt of that $1 million, we're going to give it to the insurance company. They're going to hold it in a suspension account and pay us a 2.5% interest rate. Column 4 shows you the balance of the premium deposit account. Column 5 shows you the taxable income on the premium deposit account. And column 6 shows you the 9-pay premium that we've structured so that we avoid MEC and maintain all the tax favored attributes of life insurance. So we make a one-time loan of $1 million. We do that so we lock in long-term AFR rate of 1.15%. We let the insurance company invest the money. They're really good at investing long-term bonds and laddering yield. So they're going to give us a better rate at 2.5% than the AFR, and certainly better than Lisa's earning in her bank account. And the insurance company is going to do all the heavy lifting. They're going to sweep $122,397 on the policy anniversary each year. So let's dig in here a little bit. Lisa's number one concern was liquid, flexible, guaranteed impact to net worth in year 1 is $56,000. So between the remainder balance in the premium deposit account and the policy cash value, I'm just about whole at $943,000 of surrender value in the event Lisa wants to bail. On the projected side, you'll see similar numbers. By year 5, she's made whole. We were able to secure approximately $2.6 million of death benefit, which will grow to over 3.5 at life expectancy. And all the while, we've maintained asset protected, tax diversified, chronic illness pool, which I'll get into in the next slide, which is another objective. In the event that Lisa needs some help along the way or circumstances change in her life, this program provides optimal flexibility. So remember the client-centric discussion that we opened with. We can't forget to take care of Lisa. If Lisa needs help along the way, she needs to know that this program is flexible. She needs to know that we have her covered if she becomes chronically ill. She needs to know that if she runs out of money, she wants this $1 million back in one way or another. So let's dig in a little bit here and talk about what happens if Lisa makes some bad decisions and needs to access cash flow. So remember, this is a family loan. This is a deal that Lisa made with her trust. And the least amount of interest that you can create in this promissory note is the AFR, which is 1.15%. However, there is no cap on some maybe some usury laws within our country, but there is no real cap to renegotiate, or there is no restriction to renegotiate this note. So in the event that we fast forward 19 years, Lisa's now age 70, the family trust still owes her $1 million. She's had no significant health change. She's remarried. She has made some bad decisions. You'll see the character on the right. Looks like Vegas reopened. She made some bad decisions at local casinos, mismanaged her money, needs an additional $10,000 per month after tax to continue her lifestyle. So what we do is we go back into the policy. We do a solve to see what the policy can sustain by way of distributions, and we go in and we renegotiate the loan terms, and we figure out that the policy can sustain $122,000 of distributions from age 70 to 89, right in line with her goal of $10,000 of additional cash flow after tax per month. And what we determine is that based on $1 million of present value and a payment of 128 over a 20-year period, then the interest rate solve we need to adjust the demand note or the promissory note is 11.33%. So very simply, we change the loan terms from 1.15 to 11.33. And what that does, it satisfies both principal and interest back to Lisa, helps her cash flow wise. The policy is liquid enough to make these distributions, so there's no burden or further gifts required. And we've actually met her objective along the way in any particular outcome that she was concerned with. So in the end, $1 million intra-family loan to trust will produce one or more of the following items. One or more of these outcomes will occur. A, if Lisa runs out of money, we're going to create an income stream from 70 to 89 that provide her $2.5 million of retirement income, tax-free. If she gets sick along the way, we can access $1 million of death benefit through an advance using the chronic illness rider. And if neither of those things happen, Lisa will pass $3.5 million of asset-protected legacy to her family and beneficiaries. So we have met all of her objectives. All the while, Lisa was able to do this planning from the comfort of her own home. Trust documents signed virtually, electronically. Life insurance, electronically. There is no interaction with a medical examiner. These companies are providing consideration with good medical records within the last 12 to 24 months and prescription database checks and things of that sort. We can avoid you having to use a medical examiner. This does not take multiple meetings. This is a temporary wait and see type approach that does not require the involvement of multiple advisors in multiple meetings. So we are repurposing funds from assets into cash value life insurance, utilizing this tried and true strategy of private financing, a private split dollar, whatever you want to call it, while keeping in mind this is a client-centric solution. There has nothing ever been permanent about the permanent federal estate tax. Nothing is forever. Gifts, irrevocable gifts are strong words. Clients get a little uneasy, particularly in volatile markets, when you say you need to give it away and can never get it back. So we want to create flexibility in the estate plan to change with the times. It's nothing more than a promissory note, a collateral assignment, private split dollar with a little bit of a twist where we've added the chronic illness rider and we provide the opportunity to renegotiate. And you can certainly utilize this same concept. In Lisa's case, it was cash. You can certainly utilize a similar strategy using income producing assets or real estate equities, closely held business, installment sale. The types of policies and the high liquidity features are not only used in estate planning, but they're also used in business plans where you have balance sheet sensitive companies that you can just very simply incorporate those same products and strategies onto a balance sheet of a corporation. So I thank you for for joining us this morning. I hope everyone stays safe. We wish you and your family a healthy remainder of the summer. God willing, this virus will pass and never to be seen again. In the meantime, I hope you enjoyed our presentation on how to create demand during COVID 2020 utilizing private split dollar.